Basically, what you're building into your business with life insurance is continuity for the business.
Right? You may not want to sue people, but they might want to sue you. It happens, especially when you get bigger. Welcome back to another episode of the Dan Lok Advisors series, where I bring you my personal advisor to educate you on finance and business. Today, we're going to talk about how to use financial tools, some of these tools that you could use add to your tool belt to boost your business. So share with us, what are some things that we could do?
Well, actually, there's 4 tools that would be really essential to any business. Number 1 is debt. Number 2 is high cash value life insurance. Number 3 is capital gains investments. And then number 4 would be a holding company.
Got it. And debt is not always bad, right?
No. Debt is very, very good.
Done properly, it's just a form of leverage, right? So share with us, how do we do that step by step?
Yeah, so there's a few different areas of the business that I'd like to look at as we go through these things. Number 1, again, is income. Number 2, cash flow management. Number 3, tax. And then number 4, business valuation.
Okay.
I think all 4 of those are quite important to most business owners.
Got it.
Yeah, so number 1, debt. When we look at how debt actually helps you in all 4 of these areas, when we're looking at income, for example, debt is a smoother. So over time, if you have months that you're not making so much money and then months where you're making a lot of money, you can borrow in those months when you're not making much money and then repay the debt in those months that you make more money.
Maybe you have a business that's more seasonal.
Exactly.
Perhaps, right?
Yeah, that's a very good point. So number 2 is cash flow management. So again, it's all about flexibility. So over time, we can even out the cash flow that's coming in through the business by employing debt from time to time. Number 3, so we're looking at tax, number 3. When we put debt in place, there will be certain interest charges associated with that.
Correct.
So as a result, we can get a lot of deductions in the business.
Because of the interest.
Yep.
Got it.
And then lastly, what we can do is we can use that debt to expand our business. So I've got a bit of an example of how that might work for somebody.
Sure.
So we've got an example of Gerald. So Gerald sells kitchen equipment. Okay. So he buys the kitchen equipment from China and then he resells it in the market here.
Got it.
And so Gerald has found himself in a situation where by the time he gets all the inventory over from China and sells it, he's kind of running out of money, and then he uses his money again and buys it and sells it and buys it and sells it.
Very common.
Yeah, exactly.
Very common business.
So what he needs to do to get out of that trap is he needs to bring in a lot of inventory at once, but he doesn't have the cash flow to do that. So what he does is get some debt in place, he gets a loan, and he buys a lot more inventory.
Which probably will lower the cost as well, right? Cost of goods sold.
Yeah, he's very likely the shipping costs at least will go down, right?
Correct.
So now he's brought all those goods over and he can sell them and he can earn money a lot quicker than he would otherwise. So now he's in a situation where he can look at some exponential growth and the company can grow over time because he's able to bring in more and more and more at a faster pace.
Got it. So using debt wisely.
Exactly.
Got it.
Yeah.
Got it.
Using debt to grow, and you can really grow your business to a much higher valuation from doing that. So number 2 is high cash value life insurance. So again, for income, this is a product that pays a dividend. So especially at a time like retirement, you might take the dividend as your income out of the business. From a cash flow management point of view, it's a little bit similar to debt in that what you're doing is you're building a foundational asset within your corporation.
Yes.
And you can use that to leverage against in the future. So maybe in the future, you're going to need access to a lot of capital that you weren't expecting. Now you've got this foundational asset within your corporation that you can leverage against.
Because you can borrow against your life insurance policy.
Exactly. So you can borrow from the bank, or you're guaranteed to be able to borrow from the insurance company. So there's no underwriting involved.
Yes. So it's almost like in a different way, not only get a life insurance policy, but it's a forced saving vehicle as well, right? It forces you to put money aside because you're paying the insurance policy.
Exactly.
I like that.
And you can leverage against that at any time. So you could put the money in today, and you could borrow the money out tomorrow if you wanted to.
Yes.
So
Flexibility.
yeah, there's a lot of flexibility. So then in terms of tax, the life insurance will grow tax-free within your business. And then at one point in the future, when you die, the money will come out of your business tax-free.
Got it.
And from a business valuation point of view, basically what you're building into your business with life insurance is continuity for the business. So if you were to stay on the business after selling it, they know that very key person, especially in an organization like yours, Dan.
Yes.
Someone like you being around and being insured would be very important.
Yes.
Because if you go...
Or sometimes there's certain key executives, people in your business, right?
Exactly.
Because something happens, knock on wood, it's very disruptive for the companies who are going to be those pillars, right, to run the business.
Yeah.
So that makes sense.
So a buyer, knowing that you're covered for those kind of things,
they're more comfortable because they know they got time and leeway to find the right person to come in and run the business versus you're gone and something happens, right?
Exactly.
Yeah, got it.
So capital gains investments. So again, capital gains investments are things like property or stocks, those kind of investments. So the difference is, while income, from an income perspective, they will give returns over time.
Okay.
So you can use that for income if you want to, again, like a retirement income. Number two, from a cash flow management point of view, again, you've got the ability to either sell those in the future, or you could borrow against them also.
Got it.
From a tax perspective, they are capital gains. So 50% of the capital gain is taxable. The other 50% is not taxable. So not only is it not taxable, but we can now pull that money out of the corporation as a capital dividend.
That makes sense.
So it gives us the ability to extract some money out of the corporation. And then from a business valuation point of view, if you have a lot of assets within your corporation, a lot of hard fixed assets, then it's very easy for somebody who's going to buy your corporation to assign a value to that corporation.
Because it's very clear
Yep.
how much that is worth. I like that.
So, and then number 4 is our holding company. So again, income, what it allows us to do is pay a dividend from our holding company to ourselves.
Okay.
So we can manage our income in very good detail with a holding company. Number 2, cash flow management. It means that not all of that income has to come pouring out to us. That we can pay the intercorporate dividends into the holding company, and we can hold on to it there, so we're not exposed to the 53.5% tax rate.
In Canada. So what we're talking about is essentially not just making money, but having control over how you utilize and how you flow through that money.
Exactly.
Right? It's after you make that money, now what? Right? What are some of the things, proactive things and tools that we could utilize to minimize your tax, to be ready, equip ourselves with anything that might happen that we may not be aware of, some sudden accidents or things like that, disruptions for the business, being smart about that. It's not just growing the business, but financial tools, I think as a business owner, it is our responsibility and it's our duty to know, right? We have to know some of these things. We cannot just say, oh, well, I don't know about these things, I'm not aware of these tools. It's not true, right? We should know. It's our job to know.
And from a business valuation perspective, a holding company allows us to keep our operating company very clean. So we're not mixing our assets in with the
And you can sell off the
business.
operating and it's okay. You can bring on a new operating, you make new investments, that's perfectly fine as well.
Exactly.
Yeah, and that's how we do it in Canada. Does it also provide additional layer of asset protection?
It could potentially,
Because
yes.
if someone was to sue you, they got to sue through 2 layers, right?
Exactly.
Which is also more difficult. If you've been in business long enough, knowing that could possibly happen. Knock on wood, I hope it doesn't happen for you, but you never know. Litigation is a business tool, right? You may not want to sue people, but they might want to sue you. It happens, especially when you get bigger, it's part of business, right? If you want to talk to a professional, if you want some advice on exactly how to implement some of these financial tools in your business, head over to microfamilyoffice.ca.